Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm speaking with Brendan McCurdy, Head of Research for Aries in the Wealth Business. He's going to be talking to us about the current state of private markets, where he's seeing opportunities and risks right now, and how investors can optimise an allocation to private markets in their portfolio. Hi Brendan, nice to talk to you today.
Hi, same, thank you.
So let's set the scene. It feels like private markets have been the buzzword for over the last decade, with investor appetite building each year. How have you seen that evolution gain pace within the walls at Aries?
Well, within the walls of Aries, this has been a trend for many decades. So for us, in many ways, it doesn't feel that much different. But of course, I'd say outside the walls of Aries, we've seen private markets enter into the public lexicon and show up in the media and the discourse so much more. And so, of course, there's a difference where we've seen many more questions coming in. I'd say the types of investors where the questions have come in from have changed. So certainly there's been more of a movement or an addition to the wealth business and individual investors asking about and thinking about private markets for the first time.
So the 60-40 portfolio has long been the gold standard. Why is it being questioned for today's investors?
Well, I'd say there's really a couple different forces that are starting to push investors away from thinking about the 60-40. The first is just demographic. So if you think about the fact that we have many societies that are aging, that aging population is generally looking for portfolios that have lower volatility, that are smoother, and that are kicking off income and yield for their later years. As well, you have a younger, newer generation that very often doesn't believe that traditional equities and fixed income are going to provide all the returns that they need throughout the course of their life. And then you combine that with the fact that equity valuations have been very high for a long time, so prices are very high to buy in right now. And if you kind of combine all those factors, you find yourself in a place where many people are questioning just the traditional set of equities and fixed income. I would say, in addition to that, when the 60-40 was invented, you go back to the 1960s and 1970s when that really started to become a way of thinking about investing and about building a portfolio. There were far fewer tools in the toolkit to work with when building portfolios in the 1960s and 1970s. So, I think if you were to start from scratch using everything that you had available to you today, why would you actually use the kind of old set of tools and forget about or shunt to the side all the possibilities that you have? And so what we find is investors are starting to think from first principles again, think about all the different pieces that they have to work with in putting together a portfolio. And because the private markets have performed so well over so many years and decades and make such a nice complement to those traditional equities and fixed income part of the portfolio, and we find that they're really starting to add them in good number to their investment landscape.
Okay, yes, 2025 is quite different to the 1960s. So you suggest shifting portfolios from being asset class driven to risk factor driven. Can you explain why risk factors offer a more stable foundation for portfolio construction?
Yeah, well, before we even get into thinking about factors, I'd really think about risk. And so, what you find is as an asset allocator, it's really tough to properly forecast forward-looking returns. They move around incredibly. It's hard to be very specific with it. Whereas when you're building portfolios, you actually have more control over the volatility and the correlation mixed together, the covariance. And because that covariance is more stable, it actually helps as an asset allocator to start by thinking about risk. But then as you look at risk, so many asset classes, their risks are actually really tied up with one another. So for example, if you think about high yield bonds, about a third of the ups and the downs that high yield bonds go through are being driven by what happens in the equity markets. And so if you're just thinking about risk from an asset class level, you're actually missing a lot of what's going on underneath the surface. And so instead of just thinking about risk from that top or surface level, we dig down a layer deeper to thinking about factors, and factors allow us to think about those fundamental drivers that are out there in the world that move asset classes around. So those can be drivers like equity and growth or interest rates, so think about the time value of money. There can be different diversifying factors, natural ones that exist in the world, things like commodities or credit spreads, or there can be ones that are more behavioral driven. So if you think about like equity risk premia, things like value and momentum and small cap. And then of course anything that can't be easily described or replicated, for instance, through an ETF, that anything that's left over, we think about that as alpha. And that's an important and valuable source of returns as well. So when we break the world into these fundamental factors, we get a much clearer view of what's driving portfolios up and down, and that helps us actually to better plan out and to think about how we're building portfolios and putting them together. And then what you find as well is when you are looking at all those different sources of risk and return, you're able to build more efficient portfolios that tend to have better risk-adjusted returns over time.
Your new moderate model allocates 50% to private markets. Why is that the sweet spot? And what role do private markets play that public markets can't?
Yeah, so 50% is a nice round number, and we have a number of model portfolios that we run, some for more aggressive investors, some for more conservative investors. And what you find is they all clock in pretty close. They won't all be exactly 50%, some 47, some 48, but it all tends to be around that 50%. And there's a few things that go into that. First, it is the factors, so having a balanced set of factors, equity and interest rates and credit spreads and alpha, to actually construct a portfolio with asset classes that give you exposure to all those different factors. The private markets are a really valuable source for many of those diversifying factors as well as the alpha. So that's part of what pushes a good bit of the portfolios into the private markets. And then of course there's always the balance of liquidity. So as investors think about what portion of their portfolio they need liquid, there's some portion there. And so even though a kind of traditional risk return optimization, many people in the trade call it mean variance optimization, would try and push everything to the private markets, and technically that would give you better risk-adjusted returns. There's always a balance there with making sure that there's a certain amount of the portfolio that investors can access on a daily basis.
So in recent years, we've seen returns in public markets be highly concentrated to a few names, and investors becoming wary of increasingly bullish valuations. Has this also been the case in private markets, and what are the risks you see, and can you define them for the audience?
Yeah, so private markets have actually been quite the opposite over the past many years. So for instance, as the public markets have become more concentrated in many developed Western economies, you find that there are about half as many publicly traded equities today as there were 2 or 3 decades ago. And it's actually quite the opposite in the private markets, because private capital has become more available, because it's been easier to transact in the private markets. You have so many of those companies that actually came off the public exchanges did so because they wanted to be privately held. They wanted to have that longer time frame to build value and to think about the investments that they were making and not be tied to the quarterly analyst calls. So what we found is as the public markets have contracted and the number of publicly traded companies has come down, those have migrated into the private markets. And so the private markets today are much larger, depending upon which countries' markets and investments you're looking at. Typically anywhere from 6 to 10 times the size in terms of the number of companies that you can actually invest in. So it's actually a much larger sandbox we're playing in when we're looking to invest in the private markets. And then you bring up a really good point about valuations. Valuations have also been quite different in the private markets versus the public markets. So whereas the public market valuations, or the price that you have to pay for equities, continues to rise, actually in the private markets they've been very flat for the last 3 or so years. And so what you've seen over the last few years is a big gap open up where actually the price you're paying for a private company is much lower compared to the same price you have to pay for a public company.
So you mentioned flat valuations. Can you dive into that some more? Does that also mean flat returns?
Yeah, that's a good question. So valuations we think of as really the price that we're paying for assets. So the higher the valuation, the higher the price that we have to pay. And over time is generally helpful for returns if we can pay a lower price coming in. And so one of the really nice things is that flat valuations over long periods of time is actually a helpful thing in private equity. Over long periods of time, it has not meant lower returns, and the returns in private equity have been very strong compared to the public markets. Of course, if valuations are going up, that can help existing investors because they'll continue to see the price of their assets climb. But one of the really big trends that we've seen in private equity over the last probably 15 years or so is that so much more of the returns of private equity are actually coming from operational value creation, are coming from the GP or the private equity investor actually going in and working with the business, helping the business increase how it's growing, increase its span across different geographies, for instance. And so it's much less about financial engineering and more about building actually that organic growth in the business. And so we expect to continue to see very strong returns in private equity, even without any sort of valuations increase.
Many investors worry about the illiquidity in private markets. So how should investors think about the trade-off between balancing the benefits of return and diversification with liquidity constraints?
Yeah, so I think it's just a question that investors need to ask themselves. I mean, if you think about publicly traded equities or publicly traded fixed income, for instance, depending upon which country you're in, that'll typically trade T+1, meaning that all of the trade will settle the next day or at the most the next few days. So how much of an investor's portfolio do they need available in one day is the question that we'd ask. And really the answer tends to be a pretty small portion overall. Maybe it's 10% of the investor's portfolio, maybe 20% or even 50%, but most investors probably don't need 100% of their portfolio available the next day. And that's really what you're paying for. You're paying for the privilege of that liquidity when you're investing in the public markets. And so we challenge investors, because you're paying a price and that price tends to be lower returns over time, how much of your portfolio do you really need to keep liquid and have available to come to you the next day? And whatever else you don't need, we would suggest think about keeping it available for the private markets where you might be able to earn more.
You call alpha one of the most powerful and uncorrelated factors. Ares invest in all areas of the private markets. So where are you finding the most compelling alpha opportunities right now, and also with a long-term view for the next decade?
There's a couple portions of the private markets that I'd point out. The first is real assets, and real assets meaning both real estate and infrastructure, in particular the parts of the real asset market that are tied to what we call the new economy. And so when I say the new economy, what I'm thinking about is the way that all of our lives have been changing over the last couple of years, and so much of that has to do with the amount of data that we use in everything. I think about the amount of data that my car generates when I'm driving into the office. For some of us, they've got appliances that are kicking off data. The way we get our entertainment, the way we keep up with our friends, the way our work and our offices relate, all this uses an incredible amount of data. And that changes the sort of infrastructure that we need. And of course, the big buzzword these days is artificial intelligence, or AI. And of course, that just adds even more to this sort of incredible amount of data that we need to be able to create and use efficiently. So on the infrastructure side, it's the power to actually get electricity to these data centers that are processing all these. So, so many data centers that would like to be built today, actually they're delayed because they need the hookup to the power. So for those infrastructure investors that are able to provide the power, there's an incredible opportunity there, as well as the transmission of the data. And on the real estate side, the way our lives have been changing with the new economy. If you think about warehouses, and they're kind of the lifeblood of e-commerce. And so much of what we're doing is online. So much of the way retail, the way we buy things is moving is now moving through multiple warehouses to get to us. And when we return things, that goes back through multiple warehouses again. In the real estate, so much is around industrial real estate or logistics warehouses. Also within residential, it's changing the sorts of residential, right? So if you think about the younger generation, they move around for jobs. They like nicer quality apartments with lots of amenities. And so the way the new economy shifts towards much more data usage, much more knowledge economy, these things all affect the type of real estate and also infrastructure. So I think there's a lot of potential for alpha in those areas. And then on I think a second topic that I'd point out is what we call secondaries. And so secondaries investing is being a provider of liquidity to investors who really need it. If I take an example in private equity, a lot of private equity funds have not been returning a lot of capital to their investors. There's a lot of investors, including a lot of institutional investors, that really want to actually get capital and distributions coming back to them. And so if you can actually come in, step in and help be a provider of liquidity, you can get into asset classes like private equity, a lot of times at quite a nice discount. You can, perhaps get in at 85 or 90 cents on the dollar if you're able to provide liquidity to investors. So being that secondary investor, we find really attractive. And so those are kind of two of the main core parts of the private market portfolio where we see a lot of alpha opportunities. And then maybe kind of a fun side satellite opportunity is there's a lot of interest and buzz right now in investing in sports, media, and entertainment. So while this has always been something that's happened in the background, it was much more, I think, between individual wealthy investors. And it's such a large market that now you've seen a lot of proper institutional investors coming into the space. And there's this whole ecosystem of not just the sports teams and the leagues, but actually all the companies and the services that go around those that are, we think, a really fun investment opportunity as well.
If you were in an investor's seat and looking to build a portfolio for the next decade, what would you be looking for?
Well, we'd be looking for a few things. One, I think so many investors are often thinking about things in terms of a trade. So like, what's the trade right now? Whereas really we think about it much more in terms of an allocation. And I think that's especially true in the private markets. I think many times in the past, investors were thinking about a particular fund that might have been attractive in the private markets. Whereas we'd say, think about building an allocation to the private markets. And when we talk about private markets, we're talking about four major food groups. Those are private equity, private credit, private real estate, and private infrastructure. So find a way to build a real allocation to those asset classes, just like you have your traditional equities and traditional fixed income. And then as you start to think about that allocation, our own personal preference is to use those that factor risk-based approach to building up those allocations over time, to getting a good balance between your public markets and your private markets. And then I think just being aware and looking at where there's extra potential for returns, and in particular for anyone who fancies themselves a value investor, looking at the asset classes that maybe haven't done as well the last few years or have been out of favor. Many times that's where the value is at.
Okay, great. Thank you, Brendan, for sharing your insights today and sitting down with Livewire.
No, my pleasure. Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.